please subscribe and don't forget to press the bell icon to get notified whenever we upload a new video.
Hello and welcome to our ongoing pre-budget economy special, the growth deficit balance. Ultimately, the budget is an accounting statement where the expenses can't be more than the income by more than, say, 3 to 3.2% of the GDP. Yet, whether a budget is good or bad depends on what the economists' verdict is. How much of a deficit is defensible to justify a growth stimulus? What will be the positive and negative effect of a higher deficit and the positive effect of a lower deficit? And thirdly, what are credible numbers when it comes to assumptions of, say, GDP growth or tax growth? These are some of the questions to which we will seek answers today with a bunch of A1 economists and interest rate specialists. I have with me Chetan, Ahya, Global Co-Head of Economics and Chief Asia Economist, Morgan Stanley, Hitendra, the Managing Director and Head of Global Banking and Markets at HSBC India, and Sonal, Varma, Managing Director and Chief India Economist at Nomura. Gentlemen and lady, welcome. Well, just a word more between me and my viewers. What economists tell me they normally do is they first assume what is the nominal GDP growth, that is GDP plus inflation growth, and then try to arrive at other numbers. So let me start first with that question. Sonal, for FY19, what is a good GDP growth to assume for the budget?
Well, for the budget, Latha, we are expecting both real GDP as well as the average inflation, the GDP deflators, to be higher. Our expectation for nominal GDP growth assumption, and I would say a credible assumption this time around, would be a nominal GDP growth of around 11.5%. Our expectation for real growth is that it's going to pick up to between 7.5% in FY19, and on an average, WPI and CPI inflation weighted average, we think also will be between 4.5% to 5%. So I think vis-a-vis FY18, where actually we've had advanced estimate nominal GDP growth of 9.5%, 11.5%, would be a reasonable assumption.
Okay. Your thoughts, Chetan? Therefore, what will be the overall GDP number look like? I mean, what is your assumption of nominal GDP for FY18 itself? I mean, after all, it has been brought down by the CSO. So should we say that now our GDP is what, 165 lakh crore? What will it become, you think?
So no, I agree with Sonal's numbers. We expect it to be around 11.5% to 12%, depending upon inflation. So I think that's the uncertain part of it. And also that we do think that there's upside risk to these numbers generally, because we are getting actually at the margin from the global side a strong upside in trade numbers, which is what is sending upside risk to all the Asian countries, including India. So we would say that, 11.5%, 12% nominal GDP growth number, if the government shows while they are talking about the budget, it will be a credible number, Latha.
Okay. Well, then, Chetan, the next obvious question is, therefore, what is a deficit number you're working with and a market borrowing number you're working with?
So we are operating with a deficit of 3.5% right now. We do think that they will need to show higher deficit because there will be an increase in expenditure growth in the coming financial year, because it's a pre-election year. Now, there's a possibility that they may show lower than that. We've seen that change in tack by the government in terms of increasing the collection from divestment. So if they show a very high amount of divestment, they can possibly show lower than 3.5% fiscal deficit. But at this point of time, we think it would be credible to show 3.5%, because anything lower than that will be difficult. Okay. Even if they show it lower, in the end, they will end up spending. Let's not forget this is the year before elections.
You mean you're expecting a 3.5% fiscal deficit for next year, FY19?
Look, I think there is a possibility that they may show 3.2, 3.3, and then in the end do 3.5. But I think the actual numbers will be known only much later.
Of course.
And so we are not trying to buy that, and we just want to ensure that we want to show a realistic number, what is underlying deficit likely to be.
Okay. Hitendra, how will the fixed income market react to this? What is it prepared mentally for?
My own sense actually is that I think if you look at the statements from senior policy makers and you see their actual behavior ever since this government has come into existence, I think this is one of the very few governments where cabinet ministers have openly spoken about the fact that if the sovereign itself borrows at 7, 7.5%, 8% or whatever, it creates a fairly high cost of capital for everybody else in the system. It also creates a debt trap. I think the finance minister himself has spoken about the intra-generational issues it creates, as in, we, the current generation, want the easy way out, so we borrow hundreds of thousands of crores. Kids born 10 years from now will certainly be born that much more in indebtedness. So my sense, based on the readings, based on even what they have done just in the last 2 weeks or so, trying to squeeze out expenditure, trying to do higher amount of disinvestment, is that I think the commitment, both political and economic, to stick to the fiscal deficit glide path that they have set is very much going to be their base case trial. Now, the direct tax revenue numbers thus far are holding up quite better. GST is obviously the unknown, but if I had to pick a number, I think it'll be very close to the glide path number, which is 3%, as we all know. If
the number on the table were 3.1, fixed income markets would be happy. You think you could see the 10-year contained at 7.4, 7.45?
The fixed income market, I think, is no longer in a situation where it is happy about anything, unfortunately. So it'll be relieved if it's closer to the number that I mentioned or the one you mentioned, which is 3.1. On the other hand, if it is the number that Chetan mentions, and given the mood and sentiment, which I'm sure we can talk about later, I think the reaction, it'll be a disproportionate reaction on the negative side.
Okay. Well, Sonal, what do you think the government will do? I mean, what they should do, we can go on and on. What do you think is most likely?
Well, I mean, our expectation is actually somewhere between what Chetan and Hitendra, are expecting. So our expectation is that for FY19, they'll pencil in a 3.2% of GDP. I mean, yes, the political compulsions are there, but there are a few things to also keep in mind. One is that with the cyclical recovery expected to come through next year, actually tax buoyancy will be much better. Second, GST has led to cash flow mismatches in FY18, and that's one of the main reasons, apart from the fact that the expenditure patterns were front-loaded, on why we are facing the fiscal stress for FY18. Given the tax compliance increase that's going to kick in because of GST, e-way bill, etc. coming in, actually GST collection should also pick up in FY19. Third, the spending on programs like infrastructure, etc., can still be carried out by sort of complementing it or supplementing it with borrowing through outside budgetary resources. So you can have, government companies raise money and fund capex. It does not need to suffer. And fourth, in terms of providing the right sort of stimulus to rural areas, to address the issue of farm distress, the government can enact policies that are sort of have both positive political and economic benefits. So you can have, crop insurance, scheme, more allocation towards the employment guarantee scheme, or there can be measures outside the budget as well. For instance, we've seen a number of trade policy measures in order to support, prices of sugar, wheat, edible oil, etc. So all these policies, the fiscal impact is fairly minimal. It does lead to, food inflation being a little higher than what it was in FY18 because the government would try to keep farm prices a bit, more supported into an election year. But the fiscal implications don't have to be that disastrous. So I think, I would sort of say that, the focus on fiscal consolidation should continue. And they should be able to actually show a credible number, given the tax buoyancy and other sources of financing that will also be available.
To our pre-budget economy special, the growth deficit balance, I have been speaking with Sonal Varma of Nomura, Hitendra of HSBC, and Chetan Ahya of Morgan Stanley. Well, before the break, Sonal was telling us that you can have credible numbers and still be able to find off-balance sheet ways of or policies of helping growth. What is a credible tax growth number, Chetan? Would 12% is the nominal GDP, both of you are saying will grow by about 11.5%. So what is a good tax growth assumption?
We think around 14-15% growth in tax collections would be a reasonable number because there will be an improvement in compliance. At the same time, we do think that the corporate revenue growth, which has actually been growing below GDP growth, nominal GDP growth, will actually accelerate now. And so therefore, you should see a bigger pickup in tax collection. Similarly, corporate profit growth will be much higher than the nominal GDP growth. So it would be getting collections on the corporate front as well, which is better than nominal GDP growth. So around 14-15% nominal growth in corporate tax revenues would be a good number to work with.
Okay. Well, Hitendra, you know, off-balance sheet and other ways of adjusting a borrowing program, there has been a promise from the Reserve Bank that they will relook at the FII, the cap on FII investment in debt. And there is always, of course, the RBI's OMO operations. What broadly are you expecting in FY19 on these counts?
No, so I think given the way in which RBI is quite concerned about the significant amount of capital flows are coming in and the absorptive capacity of those capital flows, I think our base case assumption is, apart from the well-flagged guideline around the percentage of outstanding government securities, which they will keep opening up at the end of each quarter, I personally don't expect any significant relook at that. I think the ownership now is quite large, and therefore I think they would want it to be much more focused on the domestic side. As far as the RBI OMO is concerned, and I think some people do think that part of the reason the fixed income market finds itself in the place that it is that on top of a fairly substantial sovereign bond supply, state loans, you had 90,000 crores of bond sales by RBI as well. I think nothing would seem to suggest that anything in the liquidity parameter would come to a point where RBI would need to sell bonds again to drain liquidity, because that being the primary objective. In fact, if the current pace of increase in currency in circulation sustains, there is a reasonable probability that next year actually RBI might have to do the reverse, as in undertake some liquidity injection, unless on the FX side they are doing so in sufficient quantities, because it does appear that the currency in circulation is increasing at a pace which is much higher than what might have been expected, say 5-6 months back or so.
Okay, yes, that is a problem. I will come back to you for a more broader view on...
but just, Latha, if I can...
Sure,
can I make a comment here, Latha?
Please, go ahead.
Okay. Only thing I was commenting was that I think if you look back, frankly, on this, whether they should undertake fiscal deficit or not, whether that should be funded through debt receipts or not, which is what borrowings are. I think if you look back a period of 10 years, which is, the best, the lowest fiscal deficit numbers was the budget for the year ended March 2008. And now you look at March 2018. And then you look at all parameters, whether you look at bank and DTL, whether you look at GDP, whether you look at tax revenues, revenue receipts. The fastest growth in this 10-year period on a compounded annual basis is in debt receipts. So, seriously, we really need to examine whether, just inflating growth through this route is really good, because you are creating massive amount of indebtedness for future generations. So I think when we look at on a year-on-year basis, we're forgetting that for 10 years now we've taken that option, and the total deficit actually in states, obviously we don't discuss much, but taken together, I think we're the highest in Asia. So if that is not inflating growth, I don't know what an incremental 0.5% will do.
Sonal, to take forward what Hitendra is saying, and very importantly, we are not discussing debt to GDP enough. Do you expect that the government, do you want the government to do it? Do you expect they will do it? And will it have a salutary impact on even the cost of money, the cost of capital?
Yeah, Latha, I think, that is quite an important question. And I think, the recommendations of the NK Singh committee have been, in the public domain for some time now. And while the government is likely to sort of deviate temporarily in FY18 because of the GST structural reform, it would be beneficial and helpful if in this budget itself the government gives clarity on the extent and the roadmap on fiscal consolidation that they are going to follow, both via in terms of the fiscal flow target on deficit as well as the stock target on the debt to GDP. So I think clarity on that would definitely, help convince investors that the government, that the deviation from fiscal consolidation that is most likely has happened in FY18 is a one-off, and that the medium-term, the medium-term commitment to fiscal consolidation remains. So, some medium-term roadmap hopefully, does get discussed in this budget.
Okay. Well, finally, Chetan, I wanted to, as an extension of the same point, how much is left really for the government to juggle and say, I'm spending on infra, I'm spending on farm? What is that kitty they have?
Well, they don't have much flexibility, Latha. That's why I was telling that they'll probably assume higher deficit, and that would be a more credible way to go around doing it. Let's not forget, I'm surprised by the other two panelists being so sanguine in the fact that, the way they have managed FY18 deficit to be closer to 3.2% eventually when it comes out, and that's something that we've learned only in the last 2 weeks, is by doing divestments, which have again not been divestments to the market. They have been done between state-owned enterprises. So look, if they do so underlying deficit, if you were to understand, or for example, the expenditure assumption that you want to make for FY19, we think will be something like closer to 15% expenditure growth in the end. And so if you assume 15% expenditure growth, and you know that you can't assume the same amount of divestment through the market, because the government has never really done this much amount of 1 trillion worth of divestment through the market. So if you're a rational assumer and saying that on FY19 they will assume a more practical number for divestment through the market, then the deficit number will be around 3.5%. So yeah, I mean, they don't have much, to answer your question, they don't have much room, and they will have to keep a higher nominal expenditure growth if they want to actually do that bit of transfer towards the year end or towards the 5-year end of their regime, and that is right before the elections. And anyways, all of us will be able to know only after the year has ended, as I was telling you. They can put now whatever they want, but we'll know it only after the year has ended.
Okay, just one number I want from Hitendra and from Sonal. Sonal, what would be your estimate of expenditure growth? What, 13%, 12%, 14%? How much is credible?
Well, I mean, our expectation is that on the capital expenditure side, there'll definitely be a double-digit, growth. And I would also want to highlight that in FY18, the capital expenditure growth actually has been fairly strong. So the quality has not been, that bad. So for FY19, we think capital expenditure growth should be in excess of 15%. Revenue expenditure more or less in line with sort of nominal GDP, or perhaps slightly under. But on an aggregate, would expect around 10 to 11% nominal expenditure growth over the revised estimates.
Hitendra, a final question to you. What is a market borrowing number which will not spook the debt markets?
Yeah, I think if the fiscal deficit is in the broad range of 3.1, that will translate into a borrowing program which will just inflate in line with the GDP growth. I think that number this year gross is about 600,000 crores, net is about 4.5 lakh crore. I think inflate that a little bit because NDTL will also grow accordingly. I think that number should be broadly okay. But just if I can just comment on this whole issue of expenditure growth, I personally think the problem is not the rate of growth of expenditure. Actually, the problem is on the tax revenue side, and I really hope, if you ask me, one thing which I'm looking for in the budget is a plan around how to take it from what it is today, high single digit for direct taxes and whatever joint direct and indirect to be quite low. What's the plan there, and how do they invest to get that up? Otherwise, we will keep focusing on this expenditure we have to cut. We have to cut out this subsidy or eliminate what they consider to be unnecessary expenditure. I really hope that the significant focus of this budget is on how do we take tax to GDP from what it is today over the next 10 years. Obviously, we are focusing on 1 year, but what's the plan? Is it MIS? Is it data? Is it computers? Is it analytics? And that, I think, is the fundamental way out of the situation of having no maneuverability, which you just mentioned earlier.
Okay. Well, that's ably wrapped up, Hitendra. Thank you very much, Hitendra, Sonal and Chetan for joining me. Actually, it's quite possible that that is the wild card, the tax revenue. As it is, the e-way bill is going to be introduced from Feb 1st. There are some tax experts who believe that that could bring in more revenue. And next year, you will have full 12 months of revenue coming in from GST. If we get our analytics right and our data mining right, probably tax to GDP ratio rising will be the government's wild card. We'll discuss that in greater detail in our next episode on the same series, The Growth Deficit Balance. Thank you very much for joining us in this edition.